Ladies and gentlemen, good morning. We are going to talk about the asset management industry. I'm very biased, but obviously I think this is the most interesting side of capital markets, but I do say that with a high degree of bias. I've got with me four leaders in the asset management industry, and very briefly, I've got Liz Corley from Allianz Global Investors, Isabelle Mateos Lago from BlackRock, Hans Stoter from NNIP, the leading Dutch asset manager, and then my colleague Hechler-Fayd'Herbe from Credit Suisse, head of investment strategy at Credit Suisse. I think actually of any panel, we probably have the most diverse group. We also have, I think, probably the highest score of any group with names which are the most difficult to pronounce. Anyway, I'd like to start off with just making the comment that I think actually we're in a very difficult situation in the asset management industry. And, you know, I've been in the industry at the risk of showing my age now for 43 years. And I actually don't think the investment environment has never been quite so difficult. And I'd just like to sort of start off with, you know, one of the big challenges that we have, which is that as at today, there are 17 European government bond markets where two-year government yields are negative. So we work in this negative and very low yield environment. And I'd just like to start off with Nannette, who was obviously from a Swiss base, faces the huge challenge of dealing with negative yields. As you all know, 10-year Swiss government bond yields today are a negative 35 basis points, and I actually think one of the worst investments in the world at the moment is actually paying the Swiss government for the honor of lending them money. Nannette, this is a huge problem from your Zurich base, and you've recently had meetings with the Swiss National Bank and taking pension funds along to the Swiss National Bank to discuss this. Do you want to just sort of comment on how we deal with this negative yield environment?
Sure, thank you, Bob. And really the biggest difficulty in thinking about that is that, in fact, although these yields are very unattractive, it every year happens that this is particularly the asset class that then performs among the best asset classes, and we are left really having to argue very hard. But more seriously, today many private investors specifically are buying these bonds to hold them until maturity, and this is where I think the argument is the easiest to make. Of course, with negative yield, they're sure to lose money if they're holding this bond to maturity. And the result of that thought has been that really as a fixed income investor, when you're looking for solutions to that issue that may be staying for quite a while with us, at least in Switzerland, we are really left to diversify as much as we can in fixed income. So for example, at Credit Suisse, we have broadened really the universe of fixed income assets in our benchmarks, not only to include, of course, credits, which has become a focus point even in Europe, of course, of the central bank, but we are also including, for example, high yield with a decent part in the benchmarks, as well as convertibles. These are only examples to make my point of really as broad diversification as possible for fixed income investors to try and not be as exposed to the one driver, which is the interest rate driver.
Isabelle, BlackRock are one of the largest fund managers in the world in fixed income. Do you adopt a similar approach?
I would say, I mean, first of all, everybody focuses on nominal rates, and that's all nice and well, but for many investors what matters is the real return, and so one shouldn't forget that inflation rates having been so low and in many cases negative, once you look at real returns, things are often not as dire. But having said that, yes, very much. We think you still get paid to take a bit more risk. You still get paid if you are willing to give up a bit of liquidity. And so the answer is, by and large, to diversify in that direction, yes.
Right. And you know, obviously one's got a huge challenge also. It's not just in fixed income with negative or low rates. One's also got a major challenge in global equity markets. And just to remind everybody, we had a major global equity market rally from March 2009. I would argue that that rally ended this time last year, and in fact, you know, over the last 12 months, global equity markets, frankly, have just been trading sideways or to some extent with a downward bias, notably since the end of last year. But valuations are still rather expensive. So actually, not just being a fixed income investor is tough, being an equity investor is tough as well. And Elizabeth, you know, at Allianz, you know, what's your equity strategy at the moment? And, you know, how do you look at value in equity markets? And, you know, this is a big challenge, running equity market positions.
Well, Bob, first of all, good morning, everybody, and it's great to be here. So, I think you have to take a step back from that. We're talking about individual asset classes, and I think both Nannette and Isabelle have made a point, which is it's actually around diversification against a clear understanding of risk and time horizon. And one has to take any investment decision in that context these days. And the biggest challenge is encouraging investors to take risk because there is no return without risk, whether that's liquidity, whether it's in capital values, whatever. So that's the first thing. Clearly, you still have to get back to, if you're an active investor making active asset allocation decisions, where are you going to put that risk budget? And that's a key question. So strategic asset allocation, thinking about risk budget explicitly, thinking about income requirements explicitly, and then thinking about the investing period for clients are fundamental to anything you do. So then if you narrow that down to asset classes, obviously there's a major role for equities. For many corporates, the dividend yield is significantly greater than their corporate bond yield because of the perversity of how we've inverted the capital structure. You do get the opportunity for capital appreciation within that. You also get the opportunity for equity price volatility. So depending on the client's investment horizon, you put equities into the portfolio in a different way. I mean, personally, in terms of where we are advising clients who've got some freedom to invest without too much concern about sort of capital volatility in the short to medium term, there's no doubt there's still value to be found, particularly in Europe. If you look at the valuation across different markets, you're right, it's reached the top end after a strong and sustained rally. We've seen a number of indices trading sideways or down with increased volatility. But if you look at the fundamentals, Europe still looks attractive. The sad news for other categories like, say, some of the very strong individual corporate performers in emerging markets is they have headwinds from other macroeconomic situations. We're in a lower return world. We've got questions about the currency movements in particular, which clearly have a major and disproportionate impact on emerging markets. So for most of our investors, and this includes US and Asian clients, we find a sustained interest in selective European equities over others, and a lot of that is the value in the dividend yield and the sustainable dividend yield. The challenge will come if there is any sort of political intervention in capital management by companies, and Kay was talking about the focus on jobs and growth. You know, one of the things we act as is a conduit of savers and investors' money into the companies and the areas that need them. So we need to think very carefully about the ways in which those capitals are flowing.
Hans, the Dutch pension fund market, I would actually argue, is probably one of the better managed pension fund markets in the world. And I'm not saying that to be polite to you, but just run through the challenges that you face at the moment in the Dutch market and how you're dealing with this issue of frankly, the not very satisfactory valuation in equity markets.
Yeah, it's true that the Dutch pension system is among the best funded pension systems in the world, but if you open a Dutch newspaper, you see that a lot of complaints are happening at the moment also about the Dutch system in the Netherlands because the coverage ratios are not at 100 but below. Now there are plenty of pension funds outside of the Netherlands that would die for a 95% coverage ratio, but in the Netherlands the debate is it should be at 105 or better. Now, it's very difficult from a return perspective to look at this. As you already said, fixed income trading at negative yields. Now, if you have interest rate sensitive liabilities, it still makes sense to own bonds. Equities, if you look at it from a risk premium perspective relative to bonds, it still looks quite attractive. But I do expect that absolute returns on equities will also be lower than the recent longer-term historic. So you basically end up in a situation where there's not a lot on the menu that is particularly attractive, but you got to eat anyway. So you try to find, construct portfolios that fit the risk profile of your client and dynamically allocate around that. We see particular growth in outcome-oriented, total return style, multi-asset, dynamically managed, volatility-controlled portfolios, where you aim for, depending on the risk profile, LIBOR plus 300, LIBOR plus 500. Not saying that it's easy to generate LIBOR 500, but it is a different way of constructing a portfolio rather than the traditional market cap-based equity or fixed income benchmark starting point portfolios.
Now, all of us, we've all been in the industry for many, many decades, and we've all lived through, I think, a whole series of crises, whether it's been emerging market crises in the 90s, whether it's been the banking crisis of 2008, etc., etc. And one of our challenges as asset managers, obviously, is to identify where there are asset bubbles and, frankly, to highlight that there are asset bubbles. There are areas of significant risk. Elizabeth was talking about risk budgets just a moment ago. And, clearly to navigate our way round those asset bubbles. And I'd just be interested in, Elizabeth, your views on, do you think there are any asset bubbles out there at the moment? Where are the areas which we as the asset management industry need to be careful of?
Well, I think you've always got to, in any asset class, in any geography, think about fundamentals of valuation. And if you get trapped into a herd instinct or a momentum play, you've got to be extremely careful. And that's particularly true when you've got excess liquidity. So I don't think it would be right to focus on any one particular area, but rather to say one has to be very, very thoughtful and cautious. Now, in the current environment, we don't have the challenges of excess leverage. In fact, if anything, one could have the discussion with Kay. We can have the discussion with Kay about what the appropriate level of leverage is. So one of the sources of historic bubbles has been, inappropriate use of leverage in the wrong exposures on asset classes. That's not there, but we do have excessive liquidity. We do have difficulties in actually pricing a risk-free rate and having that on a sustainable basis. So there's bound to be situations where you get, I would call them micro bubbles, where because of a herding of money, you're going to get a valuation mismatch and a pricing mismatch. That's normal in capital markets. And I think that's why people pay professionals to look after their money and don't put it all on whatever they think might be right. If you then say, are there any major areas where there have been significant bubbles? Well, we've got a world which is now more politically connected with geopolitical risks rising, and therefore possibly there are some areas where there is a political factor now at play that wasn't at play in past markets. So, for example, taking a very small and could be temporary, might be longer-term issue, which would be property markets in parts of the world which are subject to political disruption. And I'm not going to comment on anything that might be happening on June 23rd, but clearly when you have existential and external risks that were never priced into a particular market and there was a particular flow of demand, whether it's currency-related or asset price-related, you are going to get the risk of bubbles. I think it just talks for being very, very thoughtful, putting as much emphasis on risk management, on fundamental valuation thinking, as it does on portfolio construction.
Right. Nannette, you've just given me a look as though you'd like to address that question.
No, but I think Liz was exactly pointing to it. One of the areas, of course, where negative interest rate policy is driving, among others, investors is in real estate. And I'm thinking about Swiss real estate, which has really been shooting up in terms of value because all institutional investors practically had no other choice than to invest in real estate, whereas fundamentals are really not as buoyant and as supportive anymore. And the moment you're seeing, in some sense, a decoupling of the valuation with what is actually driving the asset class is when you have to really put all your risk management measures into place and be very, very careful about the liquidity as well, particularly on the fund side.
By the way, I just don't think it's Swiss real estate. I was in Zurich yesterday and spent 50 Swiss francs for a club sandwich, so I think it's actually Swiss club sandwiches are a bubble as well. Isabelle, BlackRock must be worried about bubbles.
No, actually not so much. And okay. I'd say there's a redeeming feature to this sideways moves in equity prices that you've mentioned, which is that, frankly, what we saw between 2009 and 2014 was stock market returns going far ahead of GDP growth, and frankly, that was unsustainable. And it's a good thing it's slowed down very much, because otherwise it would have ended in a bubble. So the fundamental drivers of growth are there. In fact, we may even be on the edge of a reflation trade in the US. So we're quite constructive about stock markets generally. But if one thinks the normal was what we saw during that period of 2009 to 2014, that's just wrong. That's a mistake. So the risk we're much more worried about, I would think, like Elizabeth said, is much more that there are some pretty big tail risks in the global economy still. Some of geopolitical nature, some of, well, I'm not even sure what label to put on it, but let's just say China, which is going through a monumentally complex transition that some countries had to do before in the history of the world, but they were not the second largest economy in the world. And so if that goes wrong, that will shock the system in very consequential ways. We don't think that's the baseline, but it's a big tail risk out there, and then there's political risk. So in terms of risk management, we're much more worried about that than about bubbles.
Fair enough. Now, switching perhaps away, we'll come back to some investment themes later on, but switching, I think, more onto investment products. Obviously, one ongoing debate, where I don't think, frankly, there's going to be any resolution to this debate, and is obviously passive versus active management. And, what we have seen is the growth of index products, the growth of the ETF market. I think the ETF market, correct me if I'm wrong, but I think it is now well in excess of $3 trillion US dollars equivalent. Hans, how do you see the growth of index products? And you may want to add to the debate on active versus passive management, where, frankly, I don't have an answer to that debate, but you might.
Well, for the people who have been in the audience yesterday with Ryanair, with the finishing slogan, low cost always wins, I think that is true in a commoditized product. If you have the lowest cost, you win, if you have a purely commoditized product. And what index trackers are doing, they're commoditizing an industry, an industry that I think should not be commoditized. Now, of course, it's also the active managers not being able to deliver on the promises that they have made to their clients, which has made the rise of passive possible. I do think that passive will continue to grow in liquid securities markets, so liquid fixed income and liquid equities. And as active managers, we should therefore redefine what active management in equities really means. A truly distinctive, impact investing, ESG-oriented, total return-focused, long-short, all different types of elements that can be part of an equity portfolio, rather than a simple market cap or a smart beta, momentum-driven, whatever factor we try to play at low cost. And at the same time, I think the active management industry, like ourselves, will be fully focusing on the more illiquid asset classes, like high yield, convertibles, or even emerging market equities, where passive is much less successful, and on private debt type of asset classes, where of course passive can never play. And to cap it all off, if you choose to buy U.S. large cap in a passive form, you have made two active decisions. One, to buy U.S. equities, and second, to buy it today. Those are active decisions that can never be made passive, because nobody has a liability profile that equals the S&P 500. So the focus on the ability to actively allocate and risk control your active allocation decisions, I think will be the key added value of our industry.
But I think that fits very well with what Liz has just been saying. Focus on the risk management and asset allocation. And I think one point that you're making very forcibly, which I completely agree with, which is that you cannot avoid active decisions. So what you're saying is actually the debate between active and passive almost is irrelevant.
Exactly.
Isabelle, you look troubled.
Agree. No, I completely agree. I don't see it as passive versus active. I think that's sort of that's almost a decade-old definition. I think it's how you choose to invest your money and what you choose to pay for. And you have to I think it's been a very helpful disaggregation of the price of running money into beta and active components. And I'm sure we'll talk about, factor investing and other things later. But that's really helpful. And I think there is no doubt that the role of, if you like, purchasing beta passively will continue to grow in exactly the areas that Hans describes. I think McKinsey think that by 2017 there'll be around, I was just checking, 14% of assets will be in passive, both in classic liquid fixed income and equity. Interestingly, they estimate 3% of profitability. And I think this is the point that there is a role for commoditization of an easily accessible, liquid, theoretically low-risk commodity product for bulk portfolio management. There's nothing wrong with that, provided it's done effectively, efficiently. You can match the index and manage the risks. And if you look at the structure of that market, there's 3 players who dominate and take nearly over 70% of the market. So it's a commoditized play. The challenge we face is that beta only gets you partway there. You're forced to make active decisions. You're forced to take risk. And in a world where there's been a significant run-up in equity values, if you buy the index at that point, inevitably you're overpaying for some part of that index just because of what's happened to equity values. So we believe very strongly that there is a role for active management, but it's going to be repriced and it's going to be redefined about a genuine risk return on that active element of the investment. And that's good. That's very good for markets. It's very good for competition. It will shake up the industry, which is probably helpful, and it will lower the overall cost of running a portfolio, which will also be helpful in a lower return world.
No, I completely agree. Isabelle, BlackRock has, I think, correct me if I'm wrong, over $2 trillion in index products?
Yes, no, that's correct.
So I think we have to ask you to comment on this debate.
I would agree with the previous speakers that the dividing line between passive and active is getting increasingly blurred. In fact, because passive products have become so much more sophisticated, and one could say commoditized, they are becoming an integral part of most active strategies, and that's cost efficient, and there's nothing wrong with that. And the pure passive products are becoming smarter. We can go into smart beta, etc., but their traditional limitations also are becoming easier to overcome. So we really see these 2 segments of the market as working together to offer asset owners solutions that are best tailored to their ultimate needs.
Well, you actually lead on to the next question. I'd like to throw this at Nannette, which is the development of smart beta. Now, the cynics amongst us, Nannette, would say smart beta is a marketing gimmick. Are they right or not?
There is a serious point in defining what is smart beta really, right? It's a way to take exposure to the market, but differently. And in fact, as soon as you say that, you can discuss about what's different. So factor investing is a way to be different from, let's say, the typical market capitalization-based benchmarks. But there's numerous different ways of weighting assets in a benchmark. So really what we are at here is taking tracking error, which is getting us back to the former conversation, where do you take risk? What do you allocate? And there's a lot of research in understanding what is making sense over the cycle, over the business, over the monetary cycle, in terms of alternative weightings. So I think there's a very serious point into exploring avenues that are different, which introduce tracking error at a decent cost. This is the whole point of the passive investments actually moving into this area. and providing cheap solutions to get tracking error in a portfolio. So I do think there's a lot of interest that the industry has to pay to smart beta.
Does anybody else want to add to that?
Only that I think that the term is a really unhelpful term.
I agree.
And it's, I mean, there are long, and not for this audience, but there are long debates about why it's actually completely inappropriate to use that phrase. But exactly as Nannette describes, looking for sustainable sources of risk premia and pricing them correctly is what portfolio management's all about. And if you can put that into a structured index and actually have a repeatable process with a lower risk, that's a very smart thing to do. But beta is beta.
Right. Hans, you referred to the demand for illiquid assets, and Nannette referred to also the issue about Swiss real estate and how valuations in certain illiquid areas are becoming somewhat stretched. But one thing I'd just like to talk about now is the challenge we face actually on areas of market illiquidity, and most of you in the room will know the ICMA, along with the Asset Management and Investors Council jointly, has done a lot of work about the problems of market illiquidity, and most notably in fixed income markets. But Hans, I'd just like to hear your thoughts on, do you think that what has happened really since the financial crisis of 2008, that we are seeing bad trends in market illiquidity, and to what extent does that cause us a problem as investors? And really across all asset classes.
Yeah, it's clear that the liquidity in fixed income markets is lower than it used to be. But I see too much debate about how we can get back to the old situation rather than how to deal with the new situation. Truly, liquidity for an asset manager is not a great problem if the liquidity of the participations in your fund matches the liquidity of the assets that are held in the fund. And that is where really the problem exists. So if you would make a chart where you have on one axis the liquidity of the assets, and on the other axis the liquidity of a fund, the participations in the fund, then on the super liquid side, on both ends, you have money markets. It's super liquid, daily T+1 fund subscriptions, and super liquid assets. On the other side of the spectrum, you have, for example, private equity. It is locked up, closed end. However, also the assets are completely illiquid. So those are completely a match, and you can draw a line, and basically everything should be on that line. Now, if you look at a hedge fund, they invest in relatively liquid markets, but in a relatively closed structure. So they're on the right side of the liquidity line, right? So the assets are more liquid than their liabilities. If you run a high-yield fund in a SICAV usage structure, then you have T+2, T+3 liquidity needed on your fund redemptions, but of course your assets are less liquid than that. So I think that imbalance needs to be addressed. And I think it is an imbalance that is a structural, how do you organize a fund? If all high-yield funds would be organized with monthly liquidity with 10% gating, and that would be the market norm, nobody would be arguing about the problem of market liquidity in high yield.
Do you think we're going to head in that direction? Because I think that's the right direction to go towards.
Well, I think there's more and more arguments being made to go there, to simply argue that we should have full trading, prop trading back at banks and brokers. I think that's a lost debate. I don't think we're going to get there. To truly focus on what is the structure and why do our clients want to invest in a specific asset class, and do they truly need daily liquidity in a high-yield corporate bond fund? And if so, should they be invested in high yield in the first place?
Yeah.
I think that is the debate we should be having.
Yeah, I agree. Now, one of the worst examples, which I won't name names, Nannette, but in the German real estate industry, we all know that there have been funds which are investing in real estate, real bricks and mortar, factories and office buildings, where we were giving investors daily liquidity so they could come in and out. And that was a classic example of what I call a liquidity trap. I don't know if you want to comment on that. I just think that was just not a great way of doing things.
No. There is
Right, okay, well, that's a very...
no other comment.
Right, well, that's a very clear comment. Elizabeth, do you want to add to that at all?
Well, maybe build on Hans's point, which is, and also something that Kay said earlier this morning, which is, you always have the regulation that was designed for yesterday. You don't have the regulation that's designed for tomorrow, unfortunately. And I think the Commission and the Parliament and the ministers are to be commended for trying to think about regulation design for tomorrow and to revisit regulation that may be individually or collectively inappropriate now. One of the things we need to look at is the way in which we can channel at a reasonable cost and good transparency long-term savings into appropriately matched investments. That's what we need for jobs, it's what we need for growth. We come out of a world where daily liquidity was meant to provide safety, and it was synonymous with safety. So transparency plus daily liquidity in a fund equals safety. I mean, that's simply not the case anymore. And I think, therefore, we need some more fundamental thinking. There was some good work done on the green paper on long-term investing, but it sort of went into the sand. And we really need to come back and think about what the economy needs for long-term sustainable investing and what savers need. And then I think Hans's point about revisiting some of the core vehicles is absolutely key.
Well, that actually brings me on to one subject which we want to discuss, which is which also leads into the discussion later today on green bond market. But the demand for portfolios, investment portfolios, which are environmentally driven, which are socially driven, which focus on sustainability. Nannette, in the Swiss market, you have seen quite a lot of demand here.
Yeah,
and I'd be interested in your thoughts on, is there any conflict or is it compatible with generating investment performance?
Over the last 10 years, indeed, in Switzerland, this has been an area that has really seen enormous growth rates of the vicinity of 20% annually in terms of assets being managed according to these criteria. And I think that one can also enlarge in this observation to Europe overall. Europe is very receptive as an investor base, both on the institutional and private side, to environmentally, socially geared investments. There are big regional differences. So, for example, in the US or in emerging markets, frankly, there is not as much interest. But we have heard yesterday that one of the biggest, for example, fixed income markets of the future in China is taking a very decided approach to, for example, green bonds. So really, we do think that in emerging markets, too, there is going to be a very strong growth case. So the bottom line is, yes, we think that this is a market that is not only growing very rapidly now, but is likely to grow and become really very diverse, very professional in the future, too. And as to your second question, is that a reasonable thing to do? I am actually on the pension fund board of Credit Suisse, and this is a conversation we have with our people that are insured with the pension fund, whether we are going to be able to get similar returns, because after all, a retirement scheme is there to fund the liabilities of the future. And the good news is that research is probably showing that you are not going to have a drawback by investing along ESG criteria. There may be sometimes sector biases if you apply exclusions, for example, and compare that to a broader market. But really the advantage, I think, of the approach is that you have, again, a risk management tool in your hand. And the returns that are, not going to be worse really than the market over a cycle of 7 or 10 years, for example, are going to, in many cases, be less risky. And that, I think, for people that are looking to invest their retirement funding, really, this is a very important piece.
It is very important, and I actually say that as a Credit Suisse pensioner. And every month I receive a cheque from Credit Suisse. I don't think I'd be desperately happy if you turned around and said, well, listen, here's 80% of the money you receive, but there's 20% of environmental happiness to go with it. Perhaps that's not a great situation. Isabelle, do you think that ESR is a formidable trend? And again, this issue of is it consistent with generating risk-adjusted investment performance?
So I'll take the non-cynical view this time.
Right.
I think it's undeniable when you do surveys of asset owners, there is growing interest for yes, ESR-friendly or ESG investing, broadly defined, particularly among women and millennials, who, after all, are going to be inheriting $30 trillion worth of assets in the coming decades. So that's great. But in a way, I would say that's almost the wrong question. And I think we're on the verge of a major energy transition in the world that's going to have massive implications for pretty much every asset class that you can think of. And so the question we need to ask ourselves as asset managers is, how does this impact our fiduciary responsibility? And every portfolio is going to be affected. And in a way, it doesn't really matter if the client is telling us, oh, I want an ESG labeled portfolio. It's every portfolio. We have to ask ourselves, how is this portfolio going to be impacted by the fact that every country in the world more or less has committed to producing energy with fewer carbon emissions, to reducing energy consumptions, and so on and so forth. And that's going to mean some industries are going to suffer tremendously, and others are going to benefit. And that's a question that is relevant to every portfolio, not regardless of the label.
Yeah. By the way, on a tangential point, I'm told that for 2 days last week, German energy consumption was 100% satisfied from alternative energy sources. So, that emphasizes, the point that you're making. I think what I'd like to do is just sort of change the conversation a little bit towards sort of structural issues in the fund management industry. And we touched on the trend towards indexed investment. But, obviously, and again, we've sort of alluded to this, but obviously one question is, to what extent do we as asset managers face fee pressure? And we all know that on the sell side, the last 7 or 8 years has seen a very significant stress on revenues. We've seen that recently in investment banking and banking results. But I'd just be interested in your thoughts on revenue pressure in the asset management industry. And Elizabeth, could you start this conversation?
Yes, I think, first of all, I think we need to say it's not just the asset management industry. You have to include the whole of the distribution chain.
Yes.
And I think undoubtedly in a lower return world, clients need value for money. And therefore, along the whole chain, right the way through, whether it's retail or institutional, there's going to be a challenge on value for money. And what I think we are already seeing and will accelerate is a willingness to pay for results. Because results are more scarce. We've got lower growth, we've got lower beta. We may be on the verge of a reflationary environment in the US, but let's see. So for a period of time, the focus is value for money. And our experience is people don't mind paying for performance because performance is still quite scarce in the world. So if you're performing, you get paid. What people don't, I think what will happen is that the price for average will drop and the price of intermediation will be scrutinized, all intermediation, as to whether it's value-added intermediation or not. And by value-added, I also would include in that security of assets, privacy and things like that. It's not just return, there are other aspects. So I think there is going to be. I think the other aspect, though, is the impact of regulation. So if you look at the UK, where there's been a very dramatic change in the retail market with the retail distribution review, the elimination of commissions, the movement of funds onto platforms, you saw a reduction in fees immediately. What's also happening now is scrutiny of things that are not just the annual management fee, but also the ongoing charges in that fund. And I think that's right. So people are looking at all the costs of looking after money and saying, please make them transparent, and I want to be able to compare them. And I don't know if Kay's still in the audience, but one thing, Kay, please do something about the PRIPS, the technical standard, to stop it going in the direction it is, because it's going to reverse 5 years of real improvement in terms of the ability to compare and contrast performance and fees.
Well, you've actually raised, I think there are 3 issues here, which is the overall level of fees. I think the second question is the transparency of fees. And then the third issue is performance fees. And performance fees is obviously a huge issue at the moment in the hedge fund industry, with the 2 and 20 fee model in the hedge fund industry being challenged quite aggressively by clients. But I'd just like to laser in on the question of performance fees. Hans, in the Dutch market, are performance fees used Is there pushback against performance fees?
I think there's still performance fees on private equities, etc.
Yes.
However, there has been pushback over the last years on performance fees on other asset classes, simply because of the focus on reducing the cost. I think many plan sponsors would be happy to pay performance fees to create alignment with their asset manager if they would be able to report the returns net of performance fees minus then the lower fixed cost that you charge as well, and show the fixed cost as the true cost of the strategy. However, the performance fees have to be shown as cost as well. So what you see is you have the gross return of the strategy minus the fixed fee plus performance fee, and all of a sudden that combination, if the asset manager is successful, looks like to be very expensive. So there's been a lot of squeezing in the institutional client side on taking out performance fee structure and replace them with pure lower fixed fees. And I even had a discussion with a large pension fund in the Netherlands, and I said, do you want to, if you had everybody wants to be on the front row and pay only 10 cents. However, if the choice is you can be on the front row of the stadium for 25 cents, or you sit on the last row for 10 cents, what would you choose? And the choice was, I'll be on the last row for 10 cents. And I was horrified. So the fee pressure is really out there. Now, of course, it is when interest rates are at 50 basis points, it's very difficult to charge active fixed income fees of 50 basis points. When rates are at 6%, it's easy to charge 50 basis points. But the work for the asset manager is the same. Right?
Yeah, I always remember, when life was very easy in the early 1980s and we had 10-year US Treasury yields at over 17%, nobody actually complained about fees. When 10-year Swiss government bond yields are minus 35 basis points, I think people do complain about fees. Nannette, do you think fees are much more transparent now, this issue of transparency? Do you think that problem's now being addressed?
I can see that certainly there are some areas, for example, in alternative investments, where there's a lot of pressure to get to the transparency of fees, just to open up the black box if one wants. And yes, I do think that this is a trend that is going to continue. I would say that with regard to fees, and again, this necessity to explore various avenues, any market, any asset that is not very efficient, where in other words, there is a value in the better knowledge of the market, is also in the future going to be able to claim higher fees. And what we see is that very specialized areas, these can be, even just small and mid caps in equities, right through to what is specialized in high yield, in distressed, etc. All of that are areas where very likely fees are going to continue being high, just because it requires not only much more resource to be put in, but also expertise that has a value because it's not readily available and it's precisely not a commodity.
A fair comment. Now, one issue I'd just like to touch on is not specifically on the hedge fund industry, but I think it's a fair comment that whereas probably 10 years ago, one had what was called the traditional asset management industry, the long-only industry, and then separately one had the hedge fund industry, the long-short industry. And I never liked being called a traditional asset manager because that implied that I was sort of, frankly, I don't like the word traditional. It implies, frankly, that you underperform the whole time. And I think it's fair to say now that that long-only and long-short industry has morphed together, and we no longer have that distinction between the two. But Liz, at Allianz Global Investors, are you developing long-short strategies, and do you agree with my comment that that distinction between long-only and long-short is no longer valid?
Well, first of all, one of the fastest growing parts of our business is illiquid and liquid alternatives, because what we've just been talking about in terms of search for yield. So whether you're going on the really illiquid side of infrastructure debt or liquid alternatives across a range of different strategies, including long-short, that's by far the fastest growing part of the business, alongside multi-asset and strategic asset allocation.
And by liquid
solutions.
alternatives, define that.
Well, you see, I don't think it's necessary to define it except by law. And you have the Alternative Investment Fund Management Directive, or you have the 40 Act Fund, or you have UCITS. So there are legal restrictions on what you can do within individual vehicles. The way we look at it is we have investors with deep philosophies and the ability to generate alpha in certain ways, some of which will be in the areas which would traditionally have been called hedge fund or alternatives.
Yes.
But, you know, if you think about the role of derivatives, whether it's in terms of hedging or whether it's in terms of seeking returns, you see those in core portfolios. The one distinction I would make with how we run money, say, compared with how some hedge funds run money, is leverage. And I think that is a very, very important distinction, and it's important that we keep that. But as soon as you remove that from the equation,
yes.
and you talk about seeking returns using all sorts of different risk premia and portfolio construction techniques, you blur, exactly as you say, Bob, from what would be called classical asset management through to some quite esoteric alternative management. Yeah.
Yes, but I'd observe that
continuum.
actually, coming back to our comment earlier on about where are asset bubbles, the leverage in the hedge fund industry today is very low compared with the leverage in the hedge fund industry, say, at till 2007. And, you know, I always sort of remember that, you know, one of the most classic hedge funds, Long-Term Capital Management, which of course went bust in September 1998, by any definition, their leverage ratio was infinity. You know, it was just completely through the roof. Yeah. But at BlackRock, if you'd looked at BlackRock 10 years ago, there was an index business and there were various long-only fixed income and equity businesses. Have you developed an alternative business?
Yes, absolutely.
Right.
No, this is an area everybody has to be in, and we're in it, and the clients want us to be in it. So there's no question. As Elizabeth said, this has to be a continuum, and I would say also increasingly, as in every other industry, what clients want is not products off a shelf. It's a solution to their needs, and providing that solution very often will include an element of alternatives offering. So there's no choice there. We have to be there.
And right. Maybe just to build on that, one thing I think which is highly relevant for ICMA is the sophistication of trading and the trading desks within asset management companies and the range of instruments that are used. And I think, again, you can see a significant stepping up in investment in trading technologies. And if you don't invest in the middle, the back office, your legal structures, in parallel with your investment capabilities, that's when some firms, I think, might have sort of unintentionally overextended. And it's an area where I think some standards and some transparency around it would be quite beneficial within the working groups.
Yeah, no, I agree completely. Now, I'd just like to sort of debunk a couple of issues in the asset management industry where we hear the words fintech being used a lot. We hear the word robo-advisors being used a lot. And I'd just be interested in your thoughts. Number one, what do you think robo-advisors are? Number two, do you think they're an accident waiting to happen? Hans, do you have robo-advisors in the Netherlands?
Well, we have some, I think, life advisors that act as robots, but that's something else. Robo-advice, for me, is a way to make the perception of a bespoke solution, but on the back end, be completely commoditized. Because this robot will basically allocate everybody into a similar type of structure. So I'm not a big believer in it. I think it's a very efficient way of managing the transition from I have a question and a need to this is your solution, but that efficiency is not necessarily effective. So I would argue that we should go for cyborg advice. So a robot systems supported,
yes.
Data supported, but still with an individual that can help translate individual needs into solutions. Because every need is different. Every person is different. And to simply have a standard algorithm that if you tick these 5 boxes, then you get that solution. I think whether it's an accident waiting to happen, I don't know. But it does lead to suboptimal solutions.
Well, one thing I've learned, and others may agree or disagree with me, is an algorithm may work today on Friday, but I guarantee on Monday it won't work. So therefore, if you're just basing yourself on an algorithm and assuming it's always going to work, I think you are storing up trouble. I don't know if anybody else wants to comment on that.
I would say I'm not sure human beings are also always guaranteed to work, but that's. But just on this point, I mean, let's be clear. Robo-advisors are just a distribution tool. Robo-advisors don't manage money. So when you ask, is this an accident waiting to happen? Well, maybe some people will be disappointed with the performance they get, and one should avoid that. But it's not like this. Robo-advisors pose systemic risk.
So it's not an accident waiting to happen, but there is scope for disappointment and there is scope for expectations not being fulfilled.
Well, that's always the case in the business.
Elizabeth, you're nodding your head.
No, I think if we go back to the challenge for the distribution side, as Isabelle said, they want more consistently predictable outcomes and they want less dispersion. Because once you get dispersion, you've got a major problem from a compliance, client satisfaction and regulation potentially point of view, and even litigation in some markets. So to the extent that you can use, whether it's algorithms or whether it's proper data analytics, to reduce the dispersion of returns and to have more predictable outcomes in certain circumstances, that's a decent risk management tool. That's not the same as advice. So I agree with Hans. This should be enabling a better quality of advice, possibly lower cost advice for those people who haven't got huge amounts of money. And I think the more sophisticated and reliable that can be, the better for the industry, actually. The challenge is it can't be a black box.
Yep.
And, sometimes some of these models are designed by the brightest, best, literally rocket scientists, which makes it very difficult, even for very bright CIOs and very bright compliance officers, to understand what's going on in the middle of the box. Therefore, the more you automate, the more you start to use data analytics, the greater the requirement for oversight and surveillance of that. And that's the challenge I think the industry faces.
Well, I think everybody knows my views on black boxes, which is please, everybody in the audience, never invest in a fund which is run by a black box where you don't know what's inside the box. So that's my plea to everybody here. We're actually running out of time, or we will be soon. We do have a few minutes for questions from your good selves. I don't know if anybody has any questions, since I actually cannot see. Right, so no questions that I can identify. So let's go back to my panelists. I think, one issue is obviously external management versus in-house management. And, to what extent there is a trend towards institutional investors, at least, moving assets away from external managers to in-house managers. And Nannette, do you see this as an issue in the Swiss market or globally for that matter?
I was really thinking about, this question in several ways. One way is that a lot of managers are internalizing their source of alpha and their source of fees. In some cases, it will mean, for example, that asset managers will have their own research rather than broker research as a result. In some cases, it will mean that there will be some products that will be managed indeed in-house. But in most of the cases, what I really see is that there is a big effort to have what is driving the asset allocation, and therefore 80% of return and risk of a portfolio that is really under the control of the internal manager. And I think this is the right thing to do, because in a time where most of the assets are now at a stage which is pretty advanced, it is a ripe stage of investments, the only chance to really beat benchmarks, the only chance to succeed as an active manager is to have a very solid and strong investment process that is your own. And this is the trend, I think, that we will be seeing, that is reflected in the growth of the multi-asset industry and products. And I think it's a very normal and good thing.
I'd just like to ask a final question to actually all four of you, which is the CFA organization has just published a very good report, which I'd encourage everybody to look at, demonstrating how the asset management industry adds value. And starting with Hans, I'd just be interested in your thoughts on what do you think are the key areas where we as an industry add value? And obviously all our comments are without any bias whatsoever.
Yeah, well, let me keep this super simple. I think as an industry, we help our clients to secure their financial futures, whether they are end retail clients or institutional clients. We should support them in delivering on their goals within their risk appetite. That means a solid degree of planning, and once that is done, to invest and protect the money that they have entrusted to us. If we deliver on that promise, our industry will thrive.
Isabelle, do you want to add to that?
Yes, well, obviously I agree. I think there's value to be added in helping clients understand where the world is going and how that matters for their portfolios and the achievement of their financial goals. Number one. Number two, I think there's a question of scale in delivering efficiency of execution, in delivering the ability to invest the huge amounts that are needed, say, to keep up with new technologies, to be able to deliver sustained alpha from, say, big data and the like. And this is obviously not something that an investor is going to be able to do in their sitting room or in their study. So there's value for scale in the profession in delivering those extra returns.
Liz?
Well, first of all, I fully support what Hans and Isabelle said, and the primary central responsibility of an asset manager is a fiduciary duty towards clients and to deliver on the investment promise and commitment to clients. I think there are two things where there's an emerging trend that we need to think about in the next few years, but it doesn't diminish that core. First one is if you look at another CFA study, which is the global study with the Edelman institution looking at trust, the thing that both retail and institutional investors put as the second most important thing for an asset manager to deliver is security of personal data and data privacy. And I think this has obviously been a major focus in the banking sector, but we shouldn't underestimate the fact that the clients place an equivalent responsibility of trust to protect data privacy and data. So that's something we need to really get our minds around. Secondly, in terms of stakeholders, we have, now that market finance is so important, we have an additional stakeholder, which is policymakers and regulators who are clearly interested in what we do. And to build on what Isabelle said, we also have to think about what our responsibilities are towards effective and efficient markets as well.
Just on the privacy of data, I actually spent the whole of Wednesday in a Credit Suisse Research Institute meeting on the whole issue of cyber security and cyber crime. And it was actually attended by a gentleman from the FBI. It's the first time I've ever had a meeting with the FBI, and actually he was pretty interesting. And it is a major problem. Nannette, please.
Yes,
rather than talking about my meeting with the FBI, please add.
There's not much more to add to what has already been said, perhaps, except one small more addition. With this very low interest rate environment, there will be more and more countries and also schemes where individuals will be asked to invest themselves for the future. So in other words, individual investment of pension money is going to become a theme that is probably likely to emerge in a number of countries. And the moment you ask an individual to take his or her future in his or her hands, that moment you want a professional standing by his or her side. So there's a great opportunity for asset managers, for professionals to put their investment processes and frankly investment standards as well as this client protection element that they can offer at the best use of these individuals. So I am quite optimistic for our industry from that standpoint.
I would just like to finish our session by saying I started by saying that I think that we operate in a very difficult environment where equity markets are not undervalued, where we have in many cases negative bond yields. I hope over the last hour with Hans, Isabelle, Elizabeth and Nannette, that we've actually given you some very clear ideas on where we as an industry are adding value in this difficult environment. And I would just sort of conclude by saying our industry is absolutely critical if you just think about global demographic trends and who is going to pay your pension when you retire. And the answer is, it's our responsibility. So we do actually have a huge responsibility on our shoulders, and we're doing everything to add value. So please join me in saying thank you very much to my panelists, and I hope we've given you a very clear picture of our industry. So thank you.